Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Comparable Company Analysis, a step-by-step guide to valuing businesses. Step 3. Gather financial information. Your next step is gathering the data. Without solid financial information, your analysis won't hold water. Start by collecting key financial details for both your target company and the comparable peers. Where do you find this information? Public filings. Look at annual, 10K, and quarterly, 10Q, reports for public companies. Market research databases. Platforms like Bloomberg or FactSet provide structured financial data. Earnings calls and presentations. Companies often reveal critical metrics in investor updates. Stock exchange websites. Sites like NASDAQ or NYSE offer summary data for listed companies. Focus on financial metrics like revenue, EBITDA, net income, market capitalization, and debt levels. Double-check numbers for reliability. Accurate inputs lead to accurate results. Step 4. Calculate valuation multiples. With your data ready, it's time to crunch the numbers. Valuation multiples are the core of comparable company analysis. These ratios let you translate raw data into actionable insights. Commonly used multiples include price to earnings, P/E, compares stock price to earnings per share. Ideal for gauging profitability. EV/EBITDA, shows enterprise value relative to operating income, removing the impact of capital structure. Price to sales, PS, links a company's revenue to its market value, a useful measure for startups. Calculating these metrics is straightforward. For example, to find P/E, divide the share price by the earnings per share. Easy, right? But don't stop at the math. Interpret the results. A higher P/E might signal growth potential, while a low EV/EBITDA could mean undervaluation. Always keep industry norms in mind when analyzing. Step 5. Apply valuation and make adjustments. Now that you've calculated the multiples, it's time to apply them. Use the averages, or medians, of the comparables' valuation multiples to estimate your target company's value. For instance, if the median P/E multiple of your peer group is 15x and your target has $5 million in net earnings, its implied market value would be $75 million, 15 by 5. But don't stop there, adjust for differences. No two companies are identical. Some factors that might need adjustments include growth rates. A company with faster growth may deserve a premium. Profit margins. Businesses with stronger margins often command higher valuations. Debt levels. Significant leverage could warrant a discount. Think of adjustments like fine-tuning a recipe. A dash of context, whether it's economic conditions or company-specific traits, could make all the difference in delivering more accurate results. By applying these steps methodically, you'll uncover a valuation range you can trust. Advantages of comparable company analysis. When it comes to valuing a business, simplicity and real-world relevance are key. Comparable company analysis, comps, checks both boxes, making it a favorite among analysts and investors alike. By comparing businesses with similar traits, this method offers a practical way to determine value and align strategies. Simplicity and quick insights. Sometimes the simplest tools are the most effective. Comps is an accessible method that doesn't require advanced math or complicated models. Instead, it focuses on real data that's easy to find and interpret. For example, by looking at valuation metrics like P/E or EV/EBITDA, you can quickly get a sense of how a company stacks up against its peers. This is especially useful when time is limited, such as during a negotiation or investment pitch. Want to see if a startup is overvalued? Pull up the P/E multiples for similar public companies. Need a quick benchmark for an acquisition deal? Compare EV/EBITDA ratios between your target and its competitors. This speed doesn't come at the expense of accuracy either. Comps simplifies the process while providing actionable insights you can trust. Think of it like using a reliable shortcut, it saves time without cutting corners. Market-driven approach. Numbers don't lie, but they don't tell the whole story if taken out of context. That's where comps really shines. It's rooted in market realities. By reflecting current trends, it provides a clear picture of how businesses are valued today, not years ago. Market forces constantly shift. Industries evolve, customer preferences change, and economic conditions fluctuate. Comps captures this dynamic by drawing on real-time data. For instance, a company with high EV/EBITDA multiples in a thriving tech sector might indicate strong growth potential. Lower P/E ratios in a struggling industry may signal undervaluation or financial challenges. This approach ensures your valuation remains grounded in the current market climate, helping you avoid outdated assumptions. Unlike more theoretical methods, comps aligns valuation with what investors are actually willing to pay. When you use comparable company analysis, you're not just crunching numbers, you're reading the market's pulse. It's a method that combines ease with relevance, making it a go-to for anyone needing reliable valuation insights. Limitations of comparable company analysis. Comparable company analysis, comps, can be helpful, but it's far from perfect. While the method focuses on real-world data and provides practical insights, it also comes with notable limitations. Poor selection choices, market unpredictability, and data inconsistencies can all impact the accuracy of your analysis. Difficulty in finding true comparables. No two businesses are exactly alike, which makes finding reliable comparables a challenge. Even within the same industry, companies may differ significantly in size, business models, or growth potential. This creates a selection bias, where the companies you choose may not truly reflect the characteristics of your target. For example, a high-growth tech company shouldn't be compared to a stable, slow-growing business in the same sector. Global companies with diverse operations may not align with regional-based firms. These differences can skew results, leading to inaccurate valuations. It's like trying to compare a sports car to an SUV. They both get you from point A to point B, but their market values are determined by entirely different factors. To minimize selection bias, drill down on key traits, like revenue size, margins, and customer base. Avoid forced comparables if no true peers exist. Sometimes, it's better to acknowledge the gap than to stretch reality. Market volatility effects. Financial markets are rarely stable. External factors like economic conditions, interest rate changes, and geopolitical events can all impact the valuation multiples used in comps. When the market is volatile, it can distort results and make it harder to draw meaningful comparisons. Here's an example. Assume you're conducting an analysis during a market downturn. Valuation multiples may be unusually low across the board because investors are cautious. Using these numbers to estimate your target company's value could lead to an undervalued result that doesn't reflect its long-term potential. On the flip side, bubbles in certain sectors, like tech in the early 2000s, can inflate multiples, giving a misleadingly high valuation. Key takeaways to manage market fluctuations. Look at historical averages to smooth out anomalies. Take note of the current economic cycle, boom versus recession. Cross-check multiples with other valuation methods for a sanity check. Market volatility can act like a funhouse mirror, distorting the true picture. By staying aware of these effects, you can make better adjustments and improve the reliability of your analysis. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.